Good afternoon, everyone. I'm Jeff Halley, a senior market analyst here at OANDA Singapore, and this is the Commodities and Precious Metals Weekly. It's been a bit of an affected week last week with Thanksgiving in the United States, which saw trading quite muted towards the end of the week as most of America indulged in the cranberry sauce turkey arbitrage. And I wish everybody a happy and fruitful Thanksgiving. And a wonderful end to the year and a wonderful 2018 while I'm at it. We have seen some significant movements, though, in commodity prices, particularly with gold and also with oil as well. And we'll talk a little bit about those in a minute. The softs were soft, to say the least, and we'll deal with those at the end of the program. Let's just get straight into it now and look at gold. Gold has slowly but surely, as the US dollar has been weakening over the last few days, been making its way to the highs of its recent 2-month range. It's been pretty hard to talk about gold for the last 2 months because it's really just sat in this sort of like bigger 1300 range, completely at the mercies of the nuances of the US dollar, as the safe haven premium in precious metals seems to have dissolved completely. And complacency has ruled, and VIX has sunk to all-time lows. With the US dollar moving back, though, with the yield curve and the 2s, 10s flattening out to 2007 lows, we have seen gold slowly but surely grind higher, almost following this line of the 100-day moving average, back towards the top of its range. It is, however, completely lacking any sort of momentum, which sort of says to me that we are going to actually struggle to get through the high here, 1306.50, with any sort of venom, so to speak, unless we see a massive sell-off in the dollar. What might cause that? Well, the market is very complacent about the FOMC coming up in mid-December. Yes, a 25 bip rise is in place, priced in, but the street does seem to be pricing in that it will be a dovish hike rather than a hawkish hike. I'm slightly disagreeing with that, to be honest. I think they are being a bit complacent, but if that is the case, that could be what we need to see gold move higher. Similarly, if the US bond yields refuse to rise with the hikes, that may undermine the US dollar as well. Clearly, 1306.5. We did look just below 1300 yesterday. We touched around 1299.33, so we failed just ahead of 1300, which is initial resistance. Today, we've seen a bit of profit taking and a bit of a zero day. First support is around 1284.85, this previous low from last Friday, and also the 100-day moving average. And then we come down to this trend line, which just let me extend that a little bit further out. And that comes in around the 1272.5 level. But slowly but surely, gold does appear to be grinding towards the top side of its range. Looking at silver, much the same again. It does seem to have be flirting with the bottom of this trend line, frankly, and I don't think the price action is actually quite as constructive here in silver as it has been in gold. We can see here, slowly but surely, it is sort of slowly contracting in its range, but it does seem to be trapped for now between this blue line, which is the 200-day moving average at 17.13, and the red line, which is the 100-day, which is at 16.99. So 16.99, 17.13 seems to be this contracting range. We are going to get a breakout after that. Next resistance is 1729.5, and this is really the key resistance up here around the 17.48. The downside looks a bit more shady, to be honest. A break of the 100-day moving average would imply a move down to around the 1680 area, and then there's really no support until we get down to this sort of 1654 area, to be honest. So I'd say, looking at this, that the resistance looks a bit more solid than the support at the moment. The precious metal everyone loves to hate, platinum. Again, trying to make a basing pattern. We can see here we've slowly but surely crawling higher. A bit like gold, though, a little unconvincing, to be honest. It seems to be one step forward and one step back, not even two steps back. The last couple of days with the weaker dollar, we've seen it attack the 100 and 200-day moving average, and the fact that they're both now at the same level around this 948 region says that in fact that platinum volatility has been pretty low, and that's why they converged. And to be honest, looking all the way back to start of October, like gold, we have been stuck in a sort of 904, 954 range. We're certainly looking like we're moving to the top side of that. It'll be interesting to see if we can close above these moving averages today, which would set us up for an attack on 955. A break of 955 actually opens up quite a lot of clear air, to be honest, and I can't really see a lot until we get around sort of to 992. But I suspect that in order to see that, we are going to have to see gold make some meaningful progress above 1300 as well. There is a definite lack of momentum. On the downside, 927.60, 920, followed by 904. Palladium. Again, still in a long-term bullish pattern. This green line here, I'm not going to blow out the chart this week. You've seen it before from previous broadcasts, but we still do have this long-term trend line here, support. And frankly, until this trend line and the blue line, the 200-day moving average, are broken, and that's around sort of the 885. 874 region. Until we see this level go, where I'm circling with the cursor, Palladium is actually still technically in a long-term uptrend. We are seeing this interim trend line here, and this actually dates back to beginning of October as well, and it's held all the pullbacks pretty well, to be honest, including of recent times. So we still seem to be flirting with this line. It could actually imply that we are getting set, to be honest, for a little bit of a correction. Above at this high of 1027, we have looked over the last 6 months, 4 months, a few times above 1,000, and each time it's not really stayed up there very long. We are in a contracting range now, so we do need to crack this level for new momentum to come into the market. A break through the bottom of this upwardly sloping trend line would imply a reasonable size correction is on the cards, and it would suggest that we're going to go all the way back to 940, the 100-day moving average, and possibly as low as 906. But as I said, we really need to see these two levels here broken in order to change our long-term view on palladium. Copper's had a bit of a rock and roller 7 days, been quite volatile. Lots of worries this week about China and a slowdown there. The market's sort of wringing its hands with a lack of other news to follow. They're worried about China slowing down steel and primary industries, generally refining industries, over winter to mollify pollution. There are a lot of stocks of ore sitting around in Chinese ports, and that's sort of taken the wind out of copper's sails over the last couple of days. Having said that, I did expect that it would break to the downside out of this triangle, and it hasn't. It actually broke to the top side. We tracked up and formed a double top here at 317, which is now fairly strong resistance in the short term. The base of this triangle, which is around 305.85, will be the interim support, followed by the base of the triangle, which is this triple bottom here, which is around 302. So some decent support around here. As long as we hold above this breakout of this triangle, that would imply that technically once 317 goes, that we will retest this 324 high. In the meantime, if we did break down through the two levels of the triangle, we still do have 297 and the 100-day moving average at 299 to support. So there is still quite a lot of support layered on the downside in copper. Natural gas, the most unloved of energies, really. We tracked up and held the top side of the range beautifully around 315. So if we needed any more confirmation that we are still stuck in a 6-month range, this one certainly gave it to us with this high here. The market had raced up higher in anticipation of winter starting in the United States and peak gas demand coming along. That hasn't happened. It's been a bit warm, which has been most annoying towards bullish traders. So that rally has certainly petered out. And what we saw is on a break of the 200-day moving average, which had held quite a few times over the last week and a half, we saw an immediate move down, testing the 100-day. And once that broke, it was clearly that some stop loss action and position liquidation went through. Not really quite sure what caused the spike yesterday in natural gas. This happened in early Asia. And that's most unusual, actually. You don't really see natural gas moving in early Asia. What's even more interesting is it seems to be consolidating its gains and trying to regain this 100-day moving average. I think, though, you have to step out of the noise in this case. There's a lot of volatility here over the last couple of weeks. But at the end of the day, it is still in a 315, 275 range. And until that changes, natural gas is more of a range trading opportunity rather than a trending opportunity. Let's head over to Brent Crude now. This week on Thursday, we have the OPEC, Non-OPEC Summit, the official OPEC meeting in Vienna on Thursday. Lovely, lovely city. Highly recommend you get there once in your life. As far as what's going to happen in the OPEC meeting, the market is well and truly priced in an extension of the oil production cut deal between the two sides of OPEC and non-OPEC until the end of 2018. There has been a few rumours over the last few days that the Russians were getting cold feet on it. They have Sakhalin 2 over in the far east of the far end of Siberia off the coast, Sakhalin Island coming on stream early next year, and I'm thinking that they're probably wondering where they're going to put that oil. One suspects it will have to go into storage, is 250,000 barrels a day. Anyway, that caused a few jitters in a very quiet news market. Looking at oil though, Brent Crude, the futures are still in backwardation, which is a bullish, longer-term, constructive price indicator. And actually, Brent Crude has been holding up pretty well near the highs of its day. We'll have a look at WTI in a minute, but it's sort of a game of two halves here. Brent is actually holding up fairly well. What could throw a few spoons, a few blockages into the process would be if they don't agree to extend the deal, or they surprise the market and extend the production cuts, i.e. increase the amount they cut per day from 1.8. That would be a massive surprise and would certainly see oil higher. Conversely, if they fail to extend the deal, you'll probably see a rush for the door in oil and possibly quite an aggressive one. Looking at the technicals, we have a double top here and here at 64.85 and sort of 64.45, and we're bubbling under that at the moment. So this is actually fairly substantial resistance now in a market that's lacking momentum. On the downside, we really don't have a lot of support. Yesterday's low around 63, and then this 2-month uptrend, which comes in around 61.5 and 61.25. I feel the must-hold level for Brent Crude is this 60.15 region, where we have 1, 2, 3 daily bottoms. So that's the must-hold level. If we break through there, then we are almost certainly going to retest the long-term trend line support that goes all the way back to mid-year, and that sits around 58.30. But that'll be a story for another day, possibly next week if things don't happen the way they're supposed to. Looking at West Texas Intermediate, it spiked last week as TransCanada had to shut down the Keystone pipeline. 600,000 barrels of Alberta oil a day goes to US refineries through it. So this has helped to support prices. Interestingly, WTI prompt futures also moved into backwardation for the first time in a very, very, very long time. Part of this may be due to the Keystone. Others may be because the US is actually exporting a shed load of oil at the moment, and it's going all over the world, and they're very quickly establishing themselves as a force in export markets. Nevertheless, TransCanada announced that I think this week they're going to reopen the pipeline, albeit at reduced pressure, and that saw some profit taking coming through in WTI overnight. We fell something like 2%. We have formed almost a double top basically at 58.85. It's close enough for government work, which sort of implies that we're going to struggle to get through 59 in the absence of any new news in the near term. A break of that does still open up quite a lot of clear air to the 61 region. On the downside, this 2-month trend line is pretty key. It comes in around sort of 56.60, and we do have a little support line ahead of that at 56.75. So 56.65, 56.75, pretty key areas for support for Brent, WTI. And a break of this would almost certainly imply that we're going to retest these lows around 54.60, and a real meltdown will bring us back to this breakout level at 52.5. Should be an interesting Thursday. Let's move over now to the agriculturals. Oopsie. Where are you? There we go. Okay, sugar is quite interesting this week. I do believe that we are still seeing, now bear in mind we did have Thanksgiving and agricultural trading drops off a lot in the United States, but it's interesting that this below expected Brazilian harvest seems to still be making its presence felt in the market, and we are testing at the moment the highs around 0.15 of sugar. And this has been the first time in a very, very long time we've been back up here. So we're going all the way back to mid-July. We closed right on that level last night. We're just bubbling under it today, and it's just below this 200-day moving average at sort of 15 cents and 15.12 cents. It'll be interesting to see if we get a daily close above the 200-day moving average. That would set us up for a move back up to around 16.5 levels. Again, not a lot of momentum, but we can see actually over the last couple of months that sugar has slowly but surely been creeping back up to the top of that range. Support initially will be around 14.30, and then the 100-day moving average way down here at 13.93. I do note, interestingly, as I've talked on about RSIs, we did touch overbought levels, and sure enough, we did have a correction there. We are still bubbling under that. We're not overbought at the moment, so we do have room to the upside. Corn. Not much to say here, to be honest, everyone. It's stuck in a range a bit like natural gas. 348, which is also now the 100-day moving average, which makes it very significant support. And 329.50 on the downside. 329.50. 348, until we get a break out of this range, it's hard to get excited about corn. It's in range trading mode. It has been suffering over the last few days because corn exports from the United States have not been at the levels that have been forecast, and that's assumed that now that there will be a surplus of corn sitting domestically in America, and thus we've seen the prices move down. This could just be a passing phase over the next few days until we get some more data we can hang our hats on. At the moment, though, we are sitting solidly mid-range. Bring a good book to read. Soybeans. Different picture. This chart's getting a little bit messy now. We had this breakout of this triangle. We went up. We held the bottom of the extension of the bottom part of the triangle. Broke down through the 200 and 100-day moving averages. Interesting, though, the 100-day moving average has crossed over and above the 200-day, and that's a long-term bullish indicator. Since then, we broke back through this level and we've extended, and then the pullback is held beautifully at this 973 level. There does appear to be very strong demand for soybeans out of China, and that's been lifting prices in the United States. We have formed a bit of a short-term resistance level now at around the 993 level. And a break of that opens up an extension all the way back up to above 10. So watch our soybeans closely. Of course, a disappointment here could see a retest of this 973 region, which again would bring these moving averages back in. It'll be interesting to see now whether this break of this triangle was in fact valid, and it just took a lot longer to form than we expected. So soybeans are very interesting levels. If we look at wheat, Wheat suffering, along with corn, lower than expected exports. I mean, the story on wheat's quite well known now. Lots and lots of countries, Russia, Ukraine, Argentina, Australia, all producing lots and lots of wheat. There's a lot more wheat on the market than there are buyers willing to pay up for it, and that is just working to keep prices depressed. We have moved back down towards the lower end of its giant trading range, which is 392.30 or 392 and 439. Again, like so many of these agriculturals, until we see a break of the long-term range, it's hard to get really, really exciting about it. Clearly now we have some resistance above the 4.2 level. We do have some support now around this 403.50-ish, but if that breaks, then I think we are going to get set for a test of this 392 region. It does look like that could be, looking at the supply and demand dynamics in the market, unless something changes there, that does look like it could be the more likely scenario for long-suffering wheat farmers. Okay, well, that's a bit shorter than normal, but no need to extend things longer than they need to be. I wish everyone a wonderful week. I hope you got something out of this, and I wish you good luck and good trading, and thank you very much for tuning in. Cheers.